Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Murray Pozmanter, Head of Clearing Agency Services and Global Business Operations at DTCC, which stands at the center of global trading activity, processing trillions of dollars of securities transactions on a daily basis. Murray, it's great to meet with you. Welcome to Trade Talks.
Thanks for having me, Jill.
And DTCC released a shorter settlement white paper encouraging the industry to move to a T+1 settlement cycle, partly in response to more frequent volatility within the markets. Let's start with the volatility environment that we saw over the past 12 months.
Sure. I mean, if you go back to the beginning of the pandemic, we've seen tremendous bouts of volatility in the market, historically high volumes as well as historically high price swings. This is going to cause a tremendous impact on our margin requirements, and I think has caused firms to really rethink the cost benefit of moving to a shorter settlement cycle. We went to a T2 settlement cycle just 3 years ago, and at the time, DTCC supported going to T1. There wasn't consensus in the industry on moving in that direction, but we think now, based on volatility that we're seeing in the market, there's an opportunity to do so.
As it relates to margin requirements, what is one of the most important concepts underpinning a move to a shorter settlement cycle?
It's really quite simple. The time between trade date and settlement date equals risk, and it equals margin. Right now, we have 3 days of unsettled trades in the system for T2, the current trading day, and 2 that are still unsettled. Taking 1 day out will have a massive impact on margin requirements. It will reduce the volatility component of our margin requirement by 40%. And when you look at the size of margin requirements over the last year, with volumes and volatility being where they are, I think the cost benefit for firms is obvious now.
Do you think the industry will be agreeable to a move to T1? And is DTCC the entity that actually pulls the trigger to make this happen?
That's a great question. I think that by and large, the industry is very supportive of moving to a shorter settlement cycle now, because they realize it's the only way to conserve capital. With respect to how that happens, DTCC doesn't ultimately make that decision. The industry needs to come to a consensus, and then there are rules that need to be changed both with the SEC as well as with FINRA. But the regulators have indicated that as long as there's industry consensus, they're open to doing so.
From a logistics perspective, how big of a lift would it be for the industry to move to T1?
I think if you use the experience of going to T2 just 3 years ago as an example, it's a significant lift, mostly in the testing. One of the advantages of going to T1 is that we're not really changing anything that happens between trade and settlement date. We're just speeding up the process. Whereas any of the moves to go to either a T0 environment or even a real-time settlement environment would require a major re-engineering of the post-trade life cycle. So while it is a lift, we don't think that it's going to be a significant lift.
And you kind of partly answered my last question there. Why not go to real-time settlement? Doesn't the technology already exist for some instruments?
Sure, and we can support T0 or even trades that are settling in near real time today. It's not really a technological issue. It's really more of a behavioral issue and a market structure issue. All securities aren't being sold by people who are long the security and being bought by people who have the cash already in their account. There's financing that needs to be arranged for trades. There are borrowers that need to be returned, short selling that needs to be facilitated. So when you look at the volumes that we had in the system during the meme stock episode just last month, we had 474 million transactions. If you're trying to settle 474 million transactions individually in real time, you're really not going to be able to have any kind of predictive financing, because firms aren't going to know what they're going to do in the market later on. You really look at the overall market structure, having that break between when trading occurs and when settlement occurs is actually quite important, both for understanding what positions have ended up at for the day, as well as to allow netting to take place. The netting that NSCC does takes 98% of the settlements out of the system, and really reduces operational and systemic risk, as well as making settlement and financing much more predictable for firms. As an example, on the high volume day last month, or the highest volume day last month, we saw upwards of $3.25 trillion in value in transactions going through the system. We only settled 58 billion. So that's a significant reduction in operational and systemic.
All right, Murray, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.